Something interesting happens after people retire, something that very few realize while they're still working. Most people assume that once you stop earning a paycheck, your wealth begins to shrink. After all, you're not making money anymore, right? But in reality, for many people, the opposite happens. Their net worth actually starts to grow faster after they retire than it did during their working years. It sounds backward, almost impossible, but the numbers and human behavior explain why it's true. For most of life, money moves in one direction, out. The early years are filled with expenses, education, housing, children, cars, debt, and daily costs that seem endless. Even people who earn good salaries often find that the more they make, the more they spend. Lifestyle inflation kicks in, and saving becomes a struggle. But as the decades pass, something changes quietly in the background. Mortgages get paid down, debts disappear, kids grow up and become financially independent. The financial drag that once slowed everything down starts to fade, and for the first time, wealth is no longer fighting against constant outflows. It begins to accumulate, often faster than before. One of the biggest reasons net worth explodes after retirement is the compounding effect finally doing its job without interruption. Throughout your working life, you're contributing to retirement accounts, 401ks, IRAs, pension funds, or personal investments. Those savings grow slowly at first, but compounding is a long game. In the early stages, the returns are small, almost invisible. But by the time you reach your 60s, the snowball has grown massive. The growth that took years to notice suddenly becomes exponential. A portfolio that added $10,000 in value during your 40s might add $100,000 a year later in your 60s without any new contributions. That's not luck or magic. It's the natural curve of compounding once it reaches critical mass. Another factor is that most retirees no longer have major liabilities. During working life, people often carry mortgages, loans, and other forms of debt. These obligations quietly chip away at wealth. When those debts are gone, net worth automatically rises, even if income drops. Imagine a couple who spent 30 years paying off their home. Once that final payment is made, their monthly expenses shrink dramatically, and their home, which might have appreciated significantly, becomes a large, debt-free asset on their balance sheet. Even without earning more, they suddenly appear far wealthier, because what they own now outweighs what they owe by a much larger margin. But there's a psychological side to this too. During working life, money often feels like a survival tool. It comes in and goes out, and the focus is always on earning more. Once people retire, that mindset shifts. Spending becomes more intentional. They're no longer buying to impress, compete, or keep up. They've already lived those years. Many retirees quietly transition into what economists call post-consumption maturity, a stage where satisfaction no longer comes from accumulation but from stability. That naturally reduces expenses, which leaves more money sitting in savings and investments, compounding quietly. At the same time, the value of assets tends to rise with time. Stocks, real estate, and even pension funds benefit from inflation and long-term market growth. While inflation is often seen as the enemy of retirees, it actually increases the nominal value of assets they already own. A house purchased for $150,000 30 years ago could easily be worth $500,000 or more today. Even if their income hasn't increased, their net worth has. This is one of the hidden ways retirees get richer on paper. Their past investments made decades ago grow passively through appreciation and time. Another overlooked reason is taxes. During working years, income is heavily taxed. Every raise, bonus, or side income gets a slice taken out before it even hits your account. But retirement income is often drawn from a mix of tax-advantaged accounts, Social Security, and investments. Many retirees are in lower tax brackets, meaning more of what they have stays in their pocket. Some even live largely off investment gains, which are taxed more favorably than ordinary income. This shift, from being a high earner to a smart withdrawer, often results in more retained wealth over time. There's also a change in how retirees manage money. They tend to become more strategic and less reactive. Working-age adults are surrounded by constant financial noise. Ads, trends, peer pressure, and an economy built to keep people spending. But retirees, free from that cycle, often live on predictable budgets. They spend less impulsively and focus more on maintaining rather than expanding. This restraint allows wealth to stabilize and over time grow. Even modest investment returns, when left untouched, can push their net worth higher year after year. Downsizing plays a big role too. Many retirees sell large homes, expensive cars, or rental properties they no longer need. The proceeds from those sales often move into diversified investments, index funds, bonds, or dividend-paying stocks, which generate steady income. This transition converts illiquid assets into income-producing ones. Instead of owning one large house that costs money to maintain, they now own a portfolio that pays them. It's a quieter kind of wealth, not flashy, but efficient. And efficiency is one of the main reasons wealth grows faster after retirement. Retirement also changes how time interacts with money. When people stop working, they stop trading hours for dollars. Their money now works for them entirely through investments. Every dollar saved is a small employee, earning returns, collecting dividends, and compounding interest. The wealthy understand this early in life, but for most people, it becomes visible only in retirement. When you no longer have to withdraw large amounts every month and your investments continue to grow, the curve steepens naturally. The absence of active income doesn't necessarily mean the end of growth. It often marks the beginning of financial independence in its purest form. It's also worth noting that retirees often benefit from longevity planning. As medical advances extend life expectancy, many retirees prepare for decades of post-work life. That encourages them to keep part of their wealth invested instead of cashing out entirely. This long-term positioning, especially when paired with moderate spending, allows portfolios to keep compounding. A retiree with $800,000 in investments earning just 6% per year adds nearly $50,000 annually in growth, even without new contributions. Over 10 years, that's $500,000 in appreciation, purely from time and discipline. There's a social aspect to this too. As people retire, their social circles often shift. They spend more time with family, travel selectively, and prioritize meaningful experiences over consumption. These lifestyle changes reduce unnecessary expenses but increase overall satisfaction. Happiness no longer depends on material upgrades. It comes from control, from knowing that life is financed, stable, and secure. And that feeling of control has a measurable financial effect. Less emotional spending, fewer impulsive decisions, and more consistency in managing money. Of course, not every retiree experiences explosive net worth growth. Health costs, poor planning, or early withdrawals can reverse the trend. But for those who manage money prudently, the combination of paid-off debts, reduced expenses, appreciating assets, and ongoing compounding creates a powerful upward curve. It's the point where decades of disciplined saving finally convert into freedom. The irony is that most people only begin to see how powerful their money truly is once they stop actively earning it. When you look at it from a distance, the pattern is clear. Retirement doesn't kill wealth. It unleashes it. After decades of saving, investing, and surviving financial ups and downs, money finally starts working on its own terms. Debts vanish, compounding accelerates, spending slows, and appreciation takes over. It's the calm stage of finance where growth happens quietly in the background. For those who prepared early, the reward is freedom. Not just to live comfortably, but to watch their lifetime of effort continue multiplying long after the work has stopped.